I'm going to keep stopping and be like, ask me questions, ask me questions. I want this to be as interactive as possible. So please know that. That's why I keep offering for you guys to ask anything, because I definitely want to make sure that I understand where you are in terms of, you know, basic knowledge about finance or accounting, and just making sure that this is actually like hitting on a level and landing on a level that makes sense for everybody. So let's just dive in. What is corporate finance? Corporate finance is so many things. It's so incredibly broad. There's no way we're going to be able to dive in and digest everything, but I'm going to give you as thorough as the taste as I can across as many different topics. This may not look like the company that you're sitting at. This is definitely more aligned with the matrix model. I mean, like, raise your hand if you've been trapped in the matrix, if you guys are used to it. I don't know. We're basically, one group is telling you one thing, the other group is saying another thing, and you spend half your life trying to get them to talk to each other and align. That's the matrix. Let me show you what I've done here and how I've pulled it in, and then we can go through and just line by line kind of talk about what these things represent. So you see here income, balance, and cash flow. So I've got all, you know, each of the financial statements listed in this on a different tab within this document. And over here, I've got their 2018 through 2021 year-end audited financial statements. Cash flow from operations is the first main piece of it. And I want to just highlight this real quick before we dive in more. There's two ways a company can show the operating portion of a cash flow statement. So this is the main one, and it is how much cash your business is generating from doing your core business. And there's the direct way and there's an indirect way. Now, most companies use the indirect method, and that's what I'm going to focus on because it's much easier for companies to do. And what it does, I'll show you in detail for Zoom in a second. It starts with net income and you start adjusting back for non-cash activity. Understanding how things flow through the model. And again, we're going to do a model. I'm going to make it somewhat complicated, but it's not going to be super complicated compared to what the real life model would look like. I've done models where they are incredibly complicated, and you have to have a lot of kind of like nuanced gyrations to come up with what the future cash flows, inflows and outflows are, and adjustments to the model. There's a lot of adjustments and things along those lines. It gets very complicated, but I want you to understand like the core fundamentals of how to do this, because this is something that you may have to do and understand and stand behind. Like, you and your finance partner, business partner may have to stand there and you have to go to the CFO and be like, yeah, that's right, I believe in it and I want $5 million. Like, that's kind of daunting. Knowing how this works will help kind of arm you with the tools you need to be able to stand there and not run out of the room. Even if a government can borrow money and can continue to lend, or continue to raise taxes and borrow money because they can control such things, it doesn't necessarily mean that it is risk-free, because there could be factors that influence it that may not be inherently financial. At times, you may have to adjust for this, where, all of a sudden, if we start seeing treasuries go up because month after month or quarter after quarter, we don't know if we're going to end up defaulting on our debt because of political games, then what ends up happening is this risk-free asset that everybody has used in the capital asset pricing model. They have used US Treasuries as the basis in the US for the risk-free rate for decades. We just be cognizant that if things start to go in a different way, you would have to reassess, is this really still truly a risk-free rate, or US Treasuries, do they have a default component starting to be priced into them? The one thing we do make an adjustment for is depreciation. So you see that it comes out of here because we're trying to get this operating profit view to calculate taxes. But down below, I actually do an add back on it, meaning because it's a non-cash charge, I take that $8 million a year and I actually add it back in. So this initial view, and this is literally how I have set up. I mean, we had an entire portfolio and a catalog of these projects when I was working in manufacturing finance. This is basically, there's more detail there, but this is a pared down version, and it's exactly how we did it. If you are supporting work on major product launches, things that will materially move the stock price if the public knew about them. It is private information, and if it impacts, meaning material, it will impact the stock price for the company. It can be considered material non-public information. It must not, and again, if you're in a large corporation, they may give you annual training on this. You must keep this information secure. You must keep it private. You must not leak this to a third party that could potentially trade on it. Bye.